Hello, folks. Charlie Gipple here with CG Financial Group. You know, this environment we're in today for annuity actuaries has to be one of the most difficult environments that anybody can be in, right? For a couple of different reasons. And I'll get to those reasons here in a bit. But if you have gotten the same emails that I have, you know that probably over, I don't know what the exact number is. There are some experts out there that'll tell you how many insurance carriers have dropped interest rates, caps, etc. in the environment today. But I would guess well over 100 since the beginning of March, right? And now, by the way, they're getting into the roll-up rates on their GLWB riders, which is significant. You know that we're down to the bone when it comes to product adjustments when they start digging into that more long-term benefit that is GLWB rates. And by the way, GLWB rates, whether it's a variable annuity company or an indexed annuity company, well, let's just demonstrate this here. Let's say that a client has $100,000, $100K going into a product. So that's $100,000 over time. That insurance carrier, with many of these guaranteed lifetime withdrawal benefit riders, that insurance carrier is guaranteeing income based off of, say, let's say a 7% roll-up rate, right? So every year that roll-up rate is 7%. And let's say that in year 5, just in this hypothetical example, 5th year, let's say in year 5 with this particular client right here, that client, let's see, 5 years, a 7% roll-up rate. Let's say that that's 140K. 140K. That client wants to start taking guaranteed income for the rest of their life based off of $140,000 income benefit. And by the way, I'm not even drawing the contract value here yet, right? The contract value is irrelevant to what the carrier actually guarantees. Well, at that point in time, that client may take income for the rest of his or her life, right? So off for 30 years, 40 years, 50 years, whatever, take an income based off that 140,000. And it is the end income that is what's most important to the carrier. The rest of this can be like funny money, but the end income number is what's most important to the carrier. Why is that? Because if that carrier has $100,000 of the client's money, and if they're charging, say, 100 basis points per year for this rider benefit here, they want to make sure that that 100 basis point rider fee is enough to cover that future income stream, right? So you discount back that future income stream by an interest rate that's much, 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 much lower than where we were, say, a couple years ago. And what you have is the amount of reserves an insurance carrier is required to hold in order to satisfy the guarantee they have to the client. It's bigger, right? If you discount something back by a lower discount rate, you have a bigger lump sum of money of reserves that the insurance carrier is required to hold. Now, all of this is irrelevant if that client's contract value was to go up well above 140,000, right? But what does this volatility in this environment mean? It means caps are dropping, which means that the probability of the client's actual contract value going up, at least to match something like that, it's slim, which is why, back in 2008 or prior to 2008, some of the variable annuities, the fee drag was getting so bad on some of those products that it was kind of a self-fulfilling prophecy that if contract values are looking like that and the insurance carrier has to cover the difference between here and there, that's really, really tough, right? And that's why in 2008, we saw a lot of these GLWBs, especially in the variable annuity world, either go away or be repriced or the rider fees increase. So the fact that you have interest rates, or cap rates, I should say, dropping on indexed annuities today, the fact that you have interest rates that are lower than where they were, say, a couple of years ago, not necessarily since the beginning of the year. I'll get into interest rates here in a bit. But the fact that you have all this volatility and uncertainty, a lot of carriers are looking at this and saying, wow, not only do we need to do the short-term thing, which is decrease caps, but we're down to the bone. And as a result, we also need to decrease, say, that 7% down to maybe 6%. So that income, the actual income amount later on in the future is not that high. Maybe it's that high, and that makes it a lot easier to hedge for that, say, 100 basis points that the carrier is charging today. Now, let's get into the real problem specifically with indexed annuities here. The real problem is, or the big problem is what I say, the right side of the pricing formula. What do I mean by the right side of the pricing formula? All right, so a client gives us $100,000, they want an indexed annuity. So $100,000, $100K, they want an indexed annuity. What does the insurance carrier who's going to issue that indexed annuity do with that $100,000? Well, maybe with $98,000, 98K, or almost all of the 100, where does that insurance company invest that $98,000? They invest that mostly into bonds, right? Mostly into corporate bonds. I think a good benchmark for the corporate bond yield that they're able to get is the Moody's BAA bond yield, right? And the Moody's BAA bond yield is actually higher than it was today. It's higher than it was at the beginning of the year. Today, it's around 4.11%. So the Moody's BAA bond yield, it's going to pay more than a treasury bond, right? Than say a 10-year treasury bond. Why? Because you have to be rewarded if you're investing in that for that credit risk that corporations have that the United States government does not have. By the way, a point here on credit risk and a point here on that credit spread. So the credit spread on the Moody's BAA bond yield today is 2.98%. That is, what that means is the Moody's BAA bond yield, remember what I said, 4.11%. The 10-year treasury bond today is only like 1.13%. So the difference between those two represents really kind of the credit risk that is the corporate bonds, right? At least high grade corporate bonds, Moody's BAA corporate bonds or BAA level corporate bonds, so 2.98%. How does that credit spread compare to where it was at the beginning of the year? Well, at the beginning of the year, again, the Moody's BAA bond yield was actually less than where it is today at 3.79%. However, the 10-year treasury bond was 1.88%. That credit spread, the difference between those two, representing the default risk at the beginning of the year or the credit risk at the beginning of the year, only 1.91%. So you can see that credit spread widening as we enter this volatile environment for, well, corporations, right? And by the way, high yield credit spreads have gotten huge. I glanced this morning, I want to say like 5, 6, 7% credit spreads above and beyond the treasury bond. So that's anticipating a lot of bankruptcies out there, right? But anyway, so I digress. Let's go back and say that $98,000, it's in corporate bonds. Let's say that today, let's be conservative. Let's say 3% is the corporate bond yield. And by the way, annuities are usually different than life insurance. Why? Because annuities are usually new money price. The bonds today, the bonds that we buy today, that is what we will invest in. To where with life insurance, it's usually a portfolio rate. So it's the overall general portfolio of the insurance company that usually determines the pricing on life insurance. And because there are older bonds in those life insurance in the portfolios of the insurance carriers, we're talking a general account yield today on average of around 4.5 to 4.6%, a heck of a lot higher than 3 in my example, or higher than 4% in my example. That's why life insurance, because they're longer duration assets, have a little bit of a pricing advantage than annuities do. Not always. If interest rates increase, annuities are more quick to adjust positively than life insurance, but I won't go there. The problem today, as I indicated, is not so much the left side of the pricing spectrum. It's more the right side of the pricing spectrum, as in, all right, so the $2,000 extra that we have, where does the insurance company take that $2,000? That $2,000 is taken to an investment bank, for instance, and one buys a call option at that investment bank. That investment bank says, let's see, so today, given how much call options cost, which by the way, call option cost, what determines call option cost? I'm going to flip this over for a second here. What determines call option cost in a big way is volatility. Also, the VIX, the VIX index is a measure of volatility. And where is the VIX index today? Wow, this has gone up like 4 points since I've been talking to you. It was at 80 like 3 minutes ago, 84.18%. So there is a somewhat direct relationship between the call option prices and how much volatility there is out there. 84.3, let's compare that to before the VIX index was even created, right? Never, never, never has that happened. Never have we experienced volatility like we're experiencing right now as I do this video. The dark days of October 2008, the VIX was I think it approached 80 or so, but not 84.09%. So therefore, clicking back over here, what does that mean? It means when we go to Goldman Sachs or whoever and say, hey, we have a notional value of 100,000, we want to buy this call option, technically buy and sell call options, but I won't go there. For $2,000, what are you going to give us as upside, basically? The investment bank says, well, based off of this call option, this bull call spread technically, but based off of you buying this call option for $2,000, we'll give you everything the market does up to, say, 5%. Today, however, that may be normal times. Today, however, that investment bank may be saying, you know what, because the market's so volatile and because these call options are so expensive, that 5% call option may instead cost you, the insurance company, say $3,000. And you say, okay, well, then for $2,000, what can I buy today? Maybe that investment bank says you can get, say, a 3% call option, a 3% cap on your indexed annuity. And that's what the carrier does. They take this math at the investment bank, they turn around and they put that in the client's contract and they call that a what? A cap, right? And then every year, that 3%, maybe the insurance carrier shaves 1% off the top. That's their profit, the insurance carriers. But then again, 2% or roughly $2,000 to buy the year 2 call options, year 3 call options, year 4 call options, and hopefully from where we are now, year 2 and 3 and 4 and so forth, we're in a cheaper environment for call option premiums than where we are today. It is that right side that is killing these insurance companies today when it comes to pricing of annuities. And this chart right here is a good demonstration of why. VIX, or implied volatility over the next 30 days, which is the VIX index, in the S&P 500 of being 83. That's unheard of, right? So it's crazy times, and these actuaries, not just the GLWB writers, but obviously this call option volatility, it's crazy. I was looking at bid-ask spreads on buying a call option at the money and then selling a call option at 3%, 4%, 5% out of the money, which is technically how these carriers do it. And the price is, up 16% today at last check. It's probably up more now. Up 16% today alone on the S&P 500, a 1-year call option to buy an at-the-money call option, up 16% today alone. So it's a rough job out there. I hope I kind of made sense here. Let me know if you have any questions.